You are listening to chartingwealth.com's daily review for Friday, the 28th of September, 2018. Special trainings at the end of this daily market review on the weekly market worksheet. We show you how to complete that. You want to supercharge your training and only have one day a week where you can fill out something. We know it takes a lot of work to fill out the daily market worksheets every day. Start with just the weekly market worksheet. We have a training at the end of the program on that. And of course, weekly and daily and trade worksheets are all available. If you look in the show notes, we have PDFs that you can copy on your own. And we can also sell you a trader's journal, but just start printing them off on your own. Later, you can get a bound copy if that's what you want. We also have a training on the derivative oscillator. That is the second type of indicator that we use. Our primary one's the price percent oscillator, but we also use the derivative oscillator, and particularly on our small chart trades. So learn about the derivative oscillator. For those of you just listening for the first time, we have an introduction to what we do here. That's also included. You'll find a link to that at the end of this daily review. And of course, information about our book, Charting Your Way to Wealth, that just fulfilled a whole bunch of orders today. And we thank you again for all your support. Let's jump into these charts. We see almost everything up for the day. Gold's the only thing down. 20-year bonds and stocks up. We're going to start with the S&P 500 as depicted by SPY, the exchange-traded fund that tracks those 500 big stocks. What do we see? Big companies. What do we see going on? Well, we have a red down candle so far for the week. The price percent oscillator's headed down. Derivative oscillators losing energy. We're still right there above the trend line on the weekly chart, so we don't have a crossover. We're just continuing to watch, wondering if this market has peaked out or not. What do we see on the two-day chart? Well, we just completed the latest two-day candle, and it's continuing to move down. Derivative oscillator gaining downward momentum. Price percent oscillator heading down. We have a red spinning top, means indecision tending down above the weekly trend line. Now again, we have the two-day in a down move, the weekly in an up move. So we don't have a trade on the S&P. We're still waiting to see how things shake out. Remember, we have to have our two bigger indicators, the weekly and the two-day, moving in the same direction before we can have a trigger event on our 4-hour chart. 4-hour chart is still in a confirmed down move. Derivative oscillators losing downward momentum. We see that price percent oscillator continuing to head down, however, and as far as our Heikin-Ashi candlesticks go, we see a green spinning top, little up movement in the morning, followed by some more in the afternoon. So we'll continue to watch the S&P and see what happens. Remember, we trend follow. We don't guess. We let the market lead us. Now, what do we see going on the Qs? We had a very important event with a weekly vertical crossover going down last Friday, the 21st of September. But so far this week, things are moving up. And what do we see happening as far as our price percent oscillator? It's almost laminated on the red signal line. So far, we have a green spinning top, means indecision tending up. The derivative oscillator is negative. Price percent oscillator is still negative. So we'll keep our eye on things. Qs was up 0.85% for the day. Remember, we never had that trigger event occur on Monday. See, this latest two-day candle is a big green up candle. But again, the two-day chart is still in a confirmed down move. Derivative oscillators losing downward momentum. Price percent oscillator heading up. But we are still just waiting to see what this 4-hour chart will do, and it keeps climbing. This is our third full day of upward movement. We see the derivative oscillator gaining down upward momentum, price percent oscillator heading up. So we don't have a trade yet. If we have this 4-hour chart crossover going down before the two-day or the weekly moves out of their down positions, then of course that would be the trigger event to jump in. And that's why we follow our rules. If we would have jumped in early on Monday when we had this first plunge, charts did not tell us to do that, you would have gotten hammered. So we didn't. We follow the rules. You want to understand those rules in full, of course, listen at the end of the podcast today to that special training we have on the introduction to charting wealth. It will get you started. And of course, you can always buy the book, but you don't have to. Let's keep moving. What do we see on 20-year bonds? They were up just a little bit for the day, 0.07%. we see that the weekly chart is still strongly moving down. Price percent oscillator still moving down, not as much as it had been the week before, but still down. And the derivative oscillator is still down. We go to the 2-day chart. What do we see there? We see that backing off. We have a green spinning top after lots of strong down movement. Pushes through the 2-day trend line. Price percent oscillator's gone flat. Derivative oscillator losing downward momentum. And that 4-hour chart, it's continued to move up for the last 2 days. Once it pierced, and again, something for you to pay attention to as you track things. The reason we have these trend lines is when they're pierced, it's important. When you have a crossover and they're pierced, even more important. So the more things that layer on top of each other, the more long-lasting the moves tend to be and the more important they are in opposite directions, telling you when to pull triggers. Sometimes things can happen, movements can occur in sideways slides that don't really trigger you getting out of trades. We warned you when we had that crossover to begin with, and then when things pushed above crossing the 2-day trend line, you want to pull back from that. Now, if the 4-hour chart crosses back over, 2-day and the weekly are still hammering down, then of course you can jump back in on that inverse move. So we'll go back to the weekly chart. And lastly, we go to gold. Gold down 0.88% for the day. Gold's been sliding sideways for quite a while. Keep wondering if it's going to cross over going up. Derivative oscillator continuing to lose downward momentum on that weekly chart. But the price percent oscillator looks like it's trying to crank over and head down again. And so far we have a red spinning top. Not one of these strong down movement candles we had from about the 20th of July through the week ending the 17th of August. But again, a spinning top, indecision tending down. And we'll continue to keep our eye on things on that 2-day chart. That was a nice big down candle. That is portending further down movement. Don't have a crossover yet on the price percent oscillator. Derivative oscillator losing downward momentum, pushing through that 2-day trend line. Once it crosses over going down, that becomes even more significant. We'll continue to watch still above that weekly trend line. And we go from the 2-day chart to the 4-hour chart, and we can see over the last 2 days, strong down movement in gold, accelerating down. So again, keep your eye on things. We were hoping gold might have bottomed out. Don't see that happening just yet, but we'll see where it ends up leading us. Now, we do see that where it's bottomed out before, somewhere around about the 111.30 mark. So we'll just continue to watch, see what we see, and if and when gold bottoms, weekly vertical crossover going up, we'll be prepared and ready to jump in if that happens. God bless, my friends. All the best from the whole team here at Charting Wealth World Headquarters. Please enjoy that weekly market worksheet training, the information about our book for sale, links there to purchase it, the derivative oscillator, and the introduction to charting the markets. God bless. All the best from the whole team here.